Alrighty, welcome back everyone. So, we're going to be doing a video on Amazon as they have dipped in the after hours. Now, how could that possibly happen after the last good quarter they had? I thought Amazon was killing it. Now, for those of you who don't know, I actually made a video on Amazon not too long ago, sometime within like the last 3 weeks to a month. And I was explaining how, I thought that they were very overvalued. And at the time, Amazon was like over $3,000 a share. It looked like nothing could go wrong for them. But I ran a discount cash flow model, a DCF model on them, and I found them to be overvalued. And I wasn't even ultra conservative with my model either, just to kind of prove a point that I felt they were overvalued. Not only that, I made a very key point in that DCF model. I pointed out that 2021's overall free cash flow was negative. And I even had someone in the comment section so determined to prove that there's no way the free cash flow could be negative. Look, I mean, I do these stock calculations on stocks. I read financials for fun. It's what I like to do. If you can read that operating cash flow is the smaller number compared to a capital expenditure, then guess what? If your operating cash flow is smaller than that capital expenditure, then your free cash flow is negative. That's just the way it works. So I found that to be alarming that the overall free cash flow for the whole year was in the negative. I didn't like the look of that, but it's something where I said, you know what? I already feel the stock is overvalued. It's not like I'm currently invested, but just for fun, I'm going to keep an eye on that free cash flow and see where it's headed in future quarters. Now, we'll get back to that in a moment once we get to the financials on the company as they have released the Q1 for 2022 earnings. But for now, meet me on the screen here and we'll take a look at just some of the highlights from this article I found about their earnings. Okay, so this is from CNBC, and there's just some of the key points that they discovered from it. But of course, we'll go into more detail once I go through the financials. But basically, here's their key points from it. Amazon on Thursday gave a revenue forecast that trailed analyst estimates. Growth rates are at their slowest since the dot-com bust in 2001. I mean, yeah, revenue might be slowing, but that's more of a, that's just a silly thing to put in there. The company recorded a $7.6 billion loss on its investment in electric vehicle maker Rivian. Okay, let's continue down in the article here, and just a little bit of highlights here. So, earnings per share, 7.38. And the expected was 8.36. So they missed pretty big on the EPS. They recorded an overall loss of $7.6 billion on the Rivian investment, which ended up resulting in an overall net loss of $3.8 billion. So, I mean, the company came out and they're blaming it on the Rivian investment, but guess what? That doesn't matter. As a company, that's something that you chose to do because, I mean, you may see a future in it, but you were trying to capitalize on the EV movement that was going on. You were trying to capitalize on it. And it's an investment. Maybe it'll pan out way down in the future, but, I mean, everyone could kind of see that EV market was, just way overinflated, and they jumped onto that ship and are sinking with it right now. So that's the reason they had to record an overall net loss of nearly $4 billion, is because of the Rivian loss of $7.6 billion. But guess what? Doesn't matter. You can't point at one particular thing and be like, that this is the reason we have a net loss. It's like, because that's something you did as a business, a financial decision you made. That's on you. Overall, it doesn't matter. Regardless, it's a loss. Now, in terms of the revenue, they pretty much met. I mean, they beat by a sliver. Revenue was $116.44 billion versus what was expected was $116.3 billion. So they did beat by a little bit. Okay, now here we go. The second quarter forecast suggests that growth could dip even further to anywhere from between 3 to 7% from the year earlier. Amazon said it projects revenue this quarter to be 116 to 121 billion, and the expectation was 125.5 billion as the analyst estimate average. So yeah, I mean, that kind of sums up the two main reasons, if you're wondering, the two main reasons that Amazon dropped in the after hours here from earnings. They did beat on revenue by a sliver. Basically, they met it, but they recorded a pretty large net loss of nearly 4 billion. But not only that, they're forecasting revenue much lower than what analysts expected. So between the net loss and the forecast, that is why they are down. Heck, they probably kind of saw something like this coming, which is why they, as we read here, although everyone knows, Amazon hiked the price of its US Prime membership for the first time in 4 years from $119 to $139. Which, look, I mean, I love using Amazon. I have stuff delivered all the time. I think there's better streaming services, but we do like Amazon Prime. So, I mean, yeah, shoot, I'm going to keep paying for it, but I don't know. I thought the increase was a little aggressive. I would have felt like $129.99 would have been okay, like a $10 increase. The $20 hike is a little aggressive, but they're going to overall make money from that and hopefully offset some of their costs. I think that just because of what's going on, with inflation and having to hire more people and pay people higher wages, that's probably cut into some of their cost as well. Now, a very big positive for Amazon, although it still doesn't make up anywhere near the majority of their revenue, as their normal retail business kind of encompasses that, but Amazon's cloud computing unit, as they describe here, continues to hum along. Sales at Amazon Web Services increased 36.5% from a year earlier to $18.44 billion, above the $18.27 billion projected by Wall Street. So, I mean, this has been a positive part of their business, is that the cloud computing part of their business is, in fact, growing well and continues to beat analyst expectations every single quarter. Now, let's go ahead and jump into just some of the financials that I wanted to go over, as earlier in the video, I did mention that 2021's free cash flow was negative. That's due to the fact that operating cash flow was lower than capital expenditure, which means you're going to end, if your capital expenditure is higher than operating cash flow, you're going to have negative free cash flow. That's just basic math. That's how it works. And a lot of the time, big capital expenditures may be a one-time thing, so that's why I say, let's look out for it in other quarters in the future to see if we see a trend continuing. So right here we have operating cash flow. And something a little concerning that I've noticed is, you kind of have what, in my opinion, I want to point out here, that peak pandemic numbers were really good. I mean, it makes sense that they were. And you have an operating cash flow at that time. Like, for example, let's just compare quarter to quarter, although you can see the numbers starting to decrease here as we go on. But Q1 of 2021 was $67.2 billion in operating cash flow. And then if you go to Q1, our operating cash flow has dropped all the way to $39.3 billion, which year over year is a drop of 41%, as they nicely highlighted right there. Now, I don't see that they've labeled capital expenditure here, as I would have liked to see how that looks, but they did label free cash flow. And if you look at Q1's overall free cash flow, and remember, this is not free cash flow for the entire quarter. This is overall trailing 12 months, as it's stating right here. So Q1 2021's trailing 12 months free cash flow, $26.4 billion. And you could already see it start to drop off in Q4 of 2021 at about 9 billion. But guess what? This is what I was afraid of, and this is the point I made in my last video and what we needed to watch out for. You can see that the trailing 12 months free cash flow updated for Q1 2022 is now a loss, or rather not a loss, but is negative free cash flow of 18.6 billion, or a change from a year ago of a negative 171%. So the person who pointed out to me, again, I don't care. I like having fun debates, but, someone adamantly was like, the free cash flow is not negative. You don't know how to read that. And I'm like, well, it's pretty simple math and the financials are right there. But, if you needed further proof, here's Amazon showing it in their own financials for the earnings Q1 that they just released. Year over year down, free cash flow down 171%. Q1 2022 trailing 12 months free cash flow negative 18.6 billion. And again, this is what I was afraid of, because here's the deal. When I do projections on a stock to gain their fair value, this is based on future free cash flow. It's the most accurate way to get the value for a company, for a stock. We project future free cash flows into the future. We discount them back with our discount rate, and we get a fair value for today. Well, you can't project future free cash flows if they're negative. And again, I just based it off of their previous positive free cash flows they had. But I said to watch out for this. If you're going to continue to see negative free cash flows quarter after quarter after quarter, you can't even really run an accurate DCF model on them anymore. This is super alarming. And if I was to run the DCF model again, which by the way, I'll link that DCF model I did in the description if you want to see what the fair value came out to, because to be honest, I can't remember off the top of my head. But whatever it was, it made a few folks mad down in the comments. But I mean, I'm going to have to, if I were to run this model again, I would have to adjust it and be more conservative, because guess what? The more quarters we have that show negative free cash flow, the less confident I am to even run a DCF model. Every company is the value of their projected future free cash flows, then discounted back at whatever discount rate you want, and you get a fair value for the company. Free cash flows are looking to be negative, at least for now. Let's see what happens over the next year, and that's not a good thing for Amazon. I'd also like to point out, is just an extra side note, that a company like Amazon, the way they work, if you look at their numbers, you'll see that it's not a very high margin type business. What I mean by that is when you look at a company like, for example, Microsoft or Google or even Facebook, I'm just naming some of the biggies. When you look at their free cash flow that they produce versus their revenue, a free cash flow margin for a company like Microsoft is something like 30% or more. Those are the margins for the free cash flow versus the revenue. However, Amazon, in terms of free cash flow versus revenue, is a much lower margin business. For example, even when Amazon was doing really well in the, last year, back in 2020 with their free cash flow that they produced versus revenue, those margins are like always under 10%. That's not Amazon's fault. That's just the nature of the business. You'll see similar type margins on a company like Alibaba. These kind of companies like Amazon, like Alibaba, etc., they are not as high margin. So they need to produce a very large amount of revenue to then, take that smaller free cash flow margin and hopefully produce a reasonable free cash flow. But the margins are not phenomenal. The numbers only looked pretty good for the past because of the fact that they generate so much revenue that even with those smaller margins that they have, the net income, the free cash flow still looks good. Although, as of late, not so much. That's in part due to the fact that they are what they are. They're retail business, technically, and the majority of their business and the majority of their revenue still is exactly that, retail driven. Now, you can look at a company like Microsoft or, Apple and be like, well, they're high margin, but they're retail driven, but they're basically a tech company. Yes, they sell retail products, but they do at high margin, and they are a tech company. Tech companies are always higher margin. Business models like Amazon and Alibaba, they just are what they are. The margins for free cash flow versus the revenue are not as high. So they need to produce a very large amount of revenue. And this is the whole reason I'm making this point right now. They have to produce a large amount of revenue. But guess what? Amazon's revenue really appears to be slowing quite a bit. And revenue forecasts are much lower than analysts expected. I'd like to see how things play out for Amazon over the next couple quarters. Obviously, I think that Amazon, even when they had their good quarter before this in Q4 of 2021, I thought they were overvalued then. I definitely think they're overvalued now, but we'll just have to see what happens over the next couple quarters or the next, over this next year here. And just see what happens. Okay, everyone, that's all I've got for you in this video. Thank you for watching, and I will see you in the next one.